Welcome to the Strategist's Playbook for Production and Costs, where we'll walk through the practical tools managers use to make smarter, more profitable choices. Over the next few minutes, we'll translate key economic ideas into actionable guidance so you can spot efficiency opportunities and shape growth decisions with confidence. Every product begins with a blueprint. Land, labor, capital, and entrepreneurship flow into a production function that turns inputs into outputs. And the critical metric to watch is marginal product, the extra output you get from one more unit of input, like hiring one more baker, producing 10 extra loaves in our diagram. Strategists live in two horizons, reacting to the now, where at least one input is fixed, and decisions optimize within constraints, and planning for the future, where all inputs become variable, and you can redesign capacity, adopt technology, or build new factories to shape a more efficient tomorrow. In the short run, your costs split into fixed costs, steady expenses like rent and salaried staff that don't change with output, and variable costs, which stretch like a rubber band and rise with production, such as beans, milk, and hourly wages. Managing profitability day to day means knowing which costs you can flex and which you cannot. Cost curves are your economic dashboard. Average fixed cost falls as you spread overhead. Average total cost shows unit economics. And marginal cost is the cost of producing one more unit. The shapes of these curves tell you where efficiency gains or losses will occur and where to focus operational improvements. The one more unit rule is simple and powerful. Marginal cost is the exact extra cost of producing one additional unit. And the decision rule says, produce the unit if its marginal revenue exceeds marginal cost, which helps you meet demand without wasting resources or overshooting capacity. Finding the sweet spot means watching how marginal cost interacts with average total cost. When marginal cost is below the average, it drags the average down, and when it's above, it pulls the average up. The crossing point marks peak efficiency, the most cost-effective level of production for the business. Playing the long game means exploiting economies of scale. As you expand, average costs per unit often fall thanks to bulk buying, technology, and labor specialization. But grow too large and dice economies appear. Communication breakdowns and logistical headaches push costs back up, so scale wisely. Before you commit resources, run a disciplined cost-benefit analysis. Identify all costs and potential benefits, assign monetary values, and question your assumptions. Then compare totals to decide. This framework helps decide things like launching a product line by weighing R&D and marketing against projected sales and market share. Setting your target means finding the break-even point, the sales level, where total revenues equal total costs. Use the contribution margin, selling price minus variable cost per unit, to calculate how many units you must sell to cover fixed costs, which informs realistic targets and pricing strategies. Avoid the strategist's trap. Sunk costs are past expenses that can't be recovered, and the fallacy is continuing a losing course simply because you already invested. Ask the forward-looking question: would I make this decision today if I hadn't already spent the money? To force a rational evaluation. Opportunity cost is the value of the next best alternative you give up, and it matters because resources are finite. If a factory chooses to make cars instead of bicycles, the foregone profit from bikes is the real cost. So acknowledging opportunity costs improves prioritization and long-term growth. Technology is reshaping the cost landscape. Traditional models show stable high costs, while modern adoption of automation, AI, and IoT brings higher upfront investment, but much lower long-term operating costs through reduced labor, predictive maintenance, and optimized production flows. The new playbook embraces modern economic models. The gig economy converts fixed payroll into flexible labor costs. The circular economy reduces raw material needs by designing for reuse and reclamation. And the sharing economy lowers capital barriers by sharing assets. each changing cost structures and strategic choices. The strategist's edge isn't a fixed plan, but constant adaptation. Core tools from marginal cost to opportunity cost remain timeless, yet the playing field shifts with technology and business models. So understand the costs, master the tools, and keep adapting your strategy as conditions evolve.